Each month, NAHB's economists produce a comprehensive analysis of the latest data developed by NAHB and other leading economic groups to provide the most up-to-date picture of the nation's economy and home-building industry in an easily digestible format. Let's take a look at the January 2025 analysis together. Beginning with a broad overview, NAHB is forecasting improved but still moderate economic growth in the years ahead. Looking back, though consumers continued to stay strong through the end of 2024, despite higher interest rates, housing was the factor that continues to lag the overall economy. Signs point to an impending consumer spending slowdown, as the current savings rate is half of its pre-pandemic level. But regarding the next couple of years, NAHB has revised its forecast growth higher to near 2% for 2025 and 1.9% in 2026 on the expectation of the extension of the 2017 tax cuts and regulatory reform. Growth will be moderated by the lagging effects of elevated interest rates and rising risks from tariffs and immigration issues, which are tied closely to President Trump's immediate priorities for his administration. As you can see on this slide, the unemployment rate, represented by the red line, remains low at 4.1%. NAHB is forecasting that we will see a slow increase in job losses, with unemployment on the rise. While lower than what was forecasted a year ago, we still anticipate unemployment approaching 4.5% in 2025. Why do we foresee an increase in job losses? Because the labor market has slowed, as seen by the decline in the blue line, which represents job openings, or a count of help-wanted signs. Demand for new workers has been cooling since the Fed began raising rates in early 2022, though there are still more than 7.5 million unfilled positions across the country. Nonetheless, today we're experiencing a tighter labor market than at any other time during the years between 2010 and 2020, as seen by the large gap between the job openings rate line and unemployment line for 2020 to 2024. Simply put, we still have too many jobs and not enough workers, even as demand cools. Deportations and policies regarding immigration may have an additional negative impact on the labor market, potentially shrinking the labor pool even further. More policy detail is required before incorporating the full effects in the forecast, but NAHB is tracking this closely. Regarding the Federal Reserve's interest rates, we expect to see rates continue to trend slowly downward over the next couple of years, even as housing inflation remains the largest inflationary component. Back in 2023, we forecasted that the Fed would be able to bring inflation growth down to 2% in 2025. But concerns about tariffs and a renewed tightness in the labor market have pushed that goal into 2026. The only way to tame housing inflation or shelter inflation, and in turn bring down overall inflation, is to build more housing. As we work to accomplish this goal, we do anticipate seeing 2 rate cuts in 2025 of about 25 basis points each, as long as there are not significant expansions in the government's deficit due to tax cuts or increased spending. For mortgages, we expect those rates to decline slowly and unevenly in 2025, with expected rates at the end of 2025 at around 6.5%, moving to sustained levels below 6% by the end of 2026. On the supply side, construction material price growth has been roughly flat on average over the past year, in part due to a decline in lumber costs. After peaking above $1,500 per thousand board feet, lumber prices hover around $435. However, builders should be aware that NAHB is forecasting gains in demand for softwood lumber as building activity rebounds, which could lead to an increase in price as demand beats out supply. We don't currently produce enough lumber in the United States to offset rising tariffs on Canadian supply, which accounts for about a third of the lumber used in this country. Increased tariffs will increase prices on a third of our lumber, if not more, in the coming years. So it's important to be prepared. Another key component of preparing your business is to support skilled labor training. A shortage of more than 250,000 workers is making it more expensive and difficult to build new housing, which is leading to a decline in single-family starts and multifamily construction, increasing the strain on the housing market. The threat of mass deportations from the new administration represents a risk to fulfilling construction jobs in 2025, which would substantially change the labor market outlook in the near term. On this slide, you can see one of the most popular graphics produced by the NAHB Economic Group, which details the components that make up the cost of a new home. Regulatory compliance makes up almost 24% of the final sales price of a newly built single-family home. And on this chart, you can see the leading resources for increased costs, including building codes, zoning issues, and other costly challenges. These regulatory costs are accelerating faster than inflation, which is why we keep a close eye on these numbers. Looking at the construction industry's outlook specifically, builders are reporting stable optimism after some post-election enthusiasm, according to the NAHB Wells Fargo Housing Market Index, NAHB's flagship index. The HMI survey, which takes the pulse of the single-family housing market, asks respondents to rate market conditions for the sale of new homes at the present time and in the next 6 months, as well as the traffic of prospective buyers of new homes. A number over 50 indicates that more builders view conditions as good. Lower than 50 indicates the conditions are worsening. The most recent HMI reading was flat at 46 in December, which indicates soft conditions. We anticipate that the HMI will remain around 50 until rates begin a continued decline. However, future sales expectations are at their highest reading since early 2022, indicating optimism in the market a little further on down the line. Another key reading that NAHB's economists keep a close eye on are single-family construction starts, which were both down in 2022 and 2023 due to higher interest rates. In 2022, starts were down 11% and down again at 6% in 2023. In 2024, rates were up 6% at around 1 million starts for the year. The forecasted increase is due to anticipations of lower interest rates and improvements in housing affordability. For now, single-family starts are forecasted to increase 1% in 2025 and 4% in 2026, up to a level of around 1.05 million starts, though growth in 2025 will be choppy. It's important to keep in mind that we need to build more than 1.1 to 1.2 million single-family homes a year to reduce the housing deficit, which we estimate to currently be around 1.5 million homes. There are so many factors that impact the work you do every day. Continue to use the NAHB Economics 5-minute slide deck, updated monthly, to inform and guide your business and your HBA. And please feel free to reach out to econ@nhb.org for any questions you may have. Stay connected to NAHB Economics for the best housing information in the market.